My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money for you. My job, not just entertain, but to put everything in context. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Investing isn't easy, but it can be a whole lot easier and much less daunting with a little instruction. The whole business of managing your money is made infinitely more confusing by all of the arcane technology and authentic Wall Street gibberish you need to wade through to learn anything about a stock or its underlying business. If you're not clued into the jargon, it can sound like the professionals are speaking an entirely different language. You got to remember that there's an entire industry of people who need you to be happily convinced that investing's too hard for you, that ordinary people just can't do it, and that the safest thing to do is to give your money to a pro. Hey, by the way, that's a huge reason why I started my charitable trust. When you join the CNBC Investing Club, our goal is to show you that you can do it yourself and to teach you how it's done. Of course, maybe giving your money to a professional is the right move for some of you, of course, but you don't have the time. But if you put in a little effort, if you do the homework, then I think you can do at least as well as the pros or a low-cost index fund, possibly the better comparison. Because in any given year, a lot of the pros really lose to index funds. The fact of the matter is that the financial industry is full of people who are just after your fees. They're more interested in taking your money than in making you money. And if you're a hedge fund or a mutual fund manager trying to fundraise, you've got every incentive to keep regular people, sadly, ignorant. Why would they make any of this investing stuff sound accessible when they could make it sound impenetrable? If it sounds too straightforward, it's harder for them to raise money and harder to convince you to pay high management fees. They're kind of like the Wizard of Oz. They don't want you peeking at the man behind the curtain. They don't want you to understand, because if you did, then you'd take control of your own finances. You'd pick your own stocks and not pay someone else potentially exorbitant fees to do the things you are perfectly capable of doing yourself. And after all these years doing the show, I know you can do it. And that's where I come in. See, I'm pulling back the curtain and explaining everything, because while authentic Wall Street gibberish can sound complex, even impenetrable, it's not rocket science or brain surgery. You don't need to go to business school or work in an investment bank to understand it. You can comprehend all the mystical-sounding vocabulary that we throw around here as long as you have a translator, a coach like me, who can explain what the darn words mean. I want you to think of me as a defector, someone who played for the other team, managing $500 million of already rich people's money at my old hedge fund, but who's now playing for you, teaching you how to navigate your way through the minefield of the stock market every weeknight here on Mad Money, and, of course, constantly for the CNBC Investing Club. Forget about the Da Vinci Code. Forget Enigma. Forget the novel code talkers. To be a great investor, first you have to break the Wall Street code, and I'm here to help you crack it. That's why tonight I'm giving you my Wall Street gibberish to plain English dictionary. Consider it a glossary of the most important terms you'll absolutely must understand if you're going to actively manage your own portfolio of individual stocks the way I want you to. Words and concepts that many people in the financial industry don't want you to get your heads around, because then you might actually feel empowered enough to pull your money out of their expensive mutual funds. And hey, even if you're not a pro, you may not know enough, so why not take advantage of my 40-plus years of investing experience to give yourself an extra edge? Let's start with a couple of extremely important terms that go hand in hand: cyclical and secular. Now, you hear these all the time, yet no one but me ever bothers to explain what they mean, even though they're crucial when it comes to picking stocks. Cyclical has nothing to do with the spin cycle on your washing machine or Wagner's ring cycle, somewhat my classical music. And secular isn't about the separation of church and state or public versus parochial schools. Oh, yes, and kudos to the late, great Lou Rukeyser, who first cracked that cyclical washing machine joke, and I've always remembered it's probably been about 50 years now. We say a company's cyclical if it needs a strong economy in order to grow. It's cyclical because it depends on the business cycle, cyclical cycle. So metals and mining companies and oil and gas, really any kind of raw materials, plus most of the industrials, are cyclical. The home builders are cyclical. The automakers are cyclical. The commodity chemical makers like Dow are cyclical. You want a bunch of copper and iron mines like BHP? That's the definition of cyclical. These companies are all hostage to the vicissitudes of the economy. When the economy heats up, they earn a lot more money, and we're willing to pay more for those earnings. And when the economy slows down or shifts into a recession mode, they earn a lot less money, and investors pay less for their shares. I always say that cyclicals are boom and bust names. Secular growth company, on the other hand, is one where the earnings keep coming regardless of the economy's overall health. Think anything you eat, drink, brush your teeth with, or use as medication. So you've got consumer staples like Procter & Gamble, of course, the foods companies like General Mills, the drug stocks like Pfizer or Merck or Eli Lilly. These are the classic recession-proof names that you want to buy when the economy slows down. Investors flock to the companies that can generate safe, consistent earnings, unless the GLP-1 drugs actually really take over the world. Because you don't stop eating food or brushing your teeth just because of recession. Okay, so why is this secular versus cyclical distinction so important? Why is it the first piece of Wall Street jargon I'm translating for you? Because it helps you figure out how much companies can earn in a given environment. And because it matters to the big institutional money managers, the guys who have so much cash to throw around that their buying and selling pretty much defines the whole market, at least in the short term. See, the whole hedge fund playbook is about when to buy and sell cyclical stocks or secular ones based on how economies around the world are doing. This is what drives the decision-making process. Now, in the old days, 50% of the performance of any individual stock came from its sector, which is just a fancy word for the segment of the economy a stock falls into, like tech, energy, machinery, healthcare, finance. And when it comes to sectors, much of their moves are driven by whether they fall into the secular or cyclical camps. These days, it's much more than 50%, and that's really thanks to the rise of sector ETFs. You don't want to own much in the way of cyclical when the economy is slowing. These stocks are simply going to get crushed because their earnings tend to fall apart, as they have during every meaningful slowdown, including Chinese slowdowns. And there's nothing about that you can do it. What do? But by the same token, when business heats up and the cyclicals are all doing well, nobody wants to own the boring, consistent secular growth names, the food and the drugs, and you won't make as much money in them during those periods either. You have to accept that. You're not a trader, you just accept it. Now, you always want some cyclical stocks and some secular stocks in your portfolio because you can never be completely sure where the economy's headed. But when business looks like it's booming, you want a lot more cyclical exposure. And when business looks like it's falling off a cliff, you want a lot more secular exposure. The bottom line, investing ain't easy, but it doesn't have to be mystifying. You just need to learn the language, know the difference between cyclical and secular growers, and always stay diversified. Shane in Alabama. Shane.
Hey, Jim. Thanks for taking my call.
Absolutely.
When building a balanced portfolio, is the 60-40 rule still fundamental, and how much of that percentage should be in cash?
Okay, I'm blowing out all that. I think that we want to bet against, don't want to bet against ourselves. We want to bet with ourselves. I am betting that people are going to have a long life, hopefully a happy life. So we're buying and keeping a lot of stock right almost to the end. When you're 60, 70, I still think that's young, and I think you should have 70% stock. I know that's higher than what I've usually said, but I just think that you're not going to get the return from bonds that people want, and I'd rather have you in stock and then take it down to 30 than 20, 30 or 20. And depending upon how you feel about yourself. I want you to be thinking about living long, and I think you'll live longer. That's my own psychology. Joseph in Florida. Joseph.
Hey, Jim. How's it going?
Not bad, Joseph. How about you? Thank you for calling.
I'm doing awesome, man.
Good.
So I wanted to get some insight on a 529 plan and or an index fund for my 1-year-old child, Jared.
All right, so you look, 529 plan is perfect, and put it in a low-fee S&P 500 index fund. I did that for my kids, and they are eternally grateful, and you're going to do it for yours, too. How about Edna in New York? Edna.
Booyah, Mr. Cramer.
Booyah,
I'm
Edna.
a new member of your investing club and wanted to thank you for all I've learned so far.
Thank
you
you.
turned my husband and I into active investors.
Well, I want you to be informed active investors. Absolutely. How can I help?
I recently rolled over an old employee IRA into a brokerage account and have 20 to 30 years before I'll need the funds. Right now, it's sitting in a money market account earning 5%. So would you recommend I put it in an S&P 500
Here's what I want
fund?
you to do. I want you to take, starting now, every month, take a 1/12 of that money and put it to work. We're not going to put it all to work at one level. 1/12. And then we get to, if we have a really bad month, I want you to double down and put 1/6 in. And when we're finished in the third and fourth quarters, well, we'll figure out whether you need to have a little more cash. But that's how I want you to invest that money. That's long-term money, and that should be in stock, not bond, but over time, not all at once. Investing isn't easy, but it doesn't have to be mystifying. You just need to learn the language. On Made Money Tonight, forget Merriam-Webster. I'm helping you demystify all that Wall Street speak. That's what you need, from PE multiples to GARP and much more. I'm cracking on my dictionary to help you navigate the market and take charge of your portfolio. That's what I want. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.